IUL tax-free retirement, indexed universal life, Dave Ramsey. Clearly, as you can tell, I am not Dave Ramsey. I am just some Asian guy that preaches on YouTube. I have a full set of hair. I'm not 60-year-old with grandchildren living in Tennessee, but I did live in the South in Alabama, so maybe that is close enough. So guys, this is the last video in our life insurance series actually. So if you haven't gotten started with our life insurance series, then please start from the top. We talk about term insurance and then we go down to whole life, variable insurance, and finally we're going to talk about indexed universal life in this video, which is the same one that I have. So I really like it and I'm going to explain the reasons why in this video. In my channel, we talk a lot about passive income, investments, and cryptocurrencies and insurances as well. So if that's something you're interested in, then please smash the like button and subscribe. And now we can jump into what we're going to talk about in this video. So you might see in the name of this title, tax-free retirement. And I'm going to start with current events because recently, like over a couple days ago, Joe Biden actually tried to propose an act to raise capital gains taxes from 20% to I believe 43.4%. So that is a huge hike in capital gains taxes. And for the rich, what they do is they try hard not to pay those taxes. And using an IUL is just one of the ways for the rich to actually not pay taxes when they retire. So it is a full loophole. And we're going to talk about that, which is why I think you should watch this entire video to understand how this tax loophole actually works. Remember guys, whatever profit you make on your investments, you have to pay taxes on. And when the government takes almost half of your profits, that sucks. So I didn't learn this before, but the first thing to do when you're getting started with investing is just getting into the right accounts such that those accounts should be tax shelters so that when you actually withdraw your gains, you actually don't have to pay tax or pay as minimum amount of tax as possible. Alright guys, I hope you're enjoying the information so far because I feel like I totally catfished you because you came here for insurance, but now you're learning about avoiding taxes, which it is completely legal the ways that I'm describing to you right now. Before we get into the IULs, let's talk about joint life and survivorship. So far in our series, we only talked about one person or you getting a life insurance policy because term insurance and permanent life insurance are just that, a policy for one person. But if you're married and there's two of you, it seems like a hassle to manage two separate policies when you're in this life together for good, right? That's why there is something called joint life and survivorship life. So joint life is a policy where it insures two or more people and the premium is based on the joint average age. For example, if we have a 41-year-old man and a 31-year-old woman who is his wife and they take a joint life policy out together, the premium is based on the age of 38 because we took 41 plus 35, which gives us 76, and we divide that by 2 to get the average of 38 years old. The difference here is that the death benefit is paid on the first death. So that means if either the husband or the wife dies, the first one that dies, the other one gets the death benefit or the money. But really guys, this type of thing is for when you see a couple with a huge age gap and they have a joint life policy together. So if that man is like 80 years old and the woman is like 30 years old and she's really happy, and they probably have a joint life policy together. All jokes aside, now let's talk about survivorship life. Survivorship life is kind of like the same thing. It insures two or more people like joint life, and the premium is also based on the joint average age. But the death benefit is based on the last death. So both of the people on the policy, both of them would have to die for the named beneficiary to be paid out. So if you guys are big Batman fans, and you should know that Bruce Wayne's parents both had survivorship life. He wasn't rich before this. It was organized for their parents to have died right in front of him by him so that he would get the death benefit from their survivorship life policy. I am just full of it. But let's take a sidetrack and take a look at group life policies because this is something that a lot of people who are employed have, but they're not really sure how it works. So we're going to talk about that before we get to IULs and how we can get tax-free retirement. When it comes to group life policy, this is not something you have to worry about. It's really something that your employer has to worry about. And the whole point of it is to get relatively inexpensive death benefit. The employer is the sponsor and they get what is called the master policy, and the employees are the insureds and they get certificates of insurance. Now the great thing about group life policies are that you can't deny people with major health problems. So if you can't get a policy yourself, getting employed is the way to go. And the biggest eligibility is that you just have to be a full-time employee. And these policies are mainly for employers and employees, debtor and creditor groups, labor unions, and associations. But if you have really major health problems and you can't get an insurance policy by yourself, really consider just getting employed and getting a health insurance policy or life insurance policy that way. And lastly, while we're on the topic, let's talk about group conversion requirements, because if you get laid off or fired, you lose your insurance. So what do you do in that situation? Well, if you have been fired or laid off, if you have been under the group plan for at least 5 years, you can convert your group life policy into a whole life policy. And you need to make this conversion within 31 days. You don't need to provide proof of insurability within that period, but your premiums will go up because you just converted it to an individual plan, and individual plans are always more expensive than group plans. Alright, let's do a recap of whole life versus variable life, and then we'll add in index universal life and talk about which one is right for whom. So with whole life, your cash value is in a general account. That means that the insurer manages and bears all the risks for the interest rate that you're getting. That means that if you are promised 3% interest rate in that policy, you will get 3%. There is no other way. For variable life, this is an insurance-based product. What that means is the cash value is in a separate account, and the cash value in it fluctuates with the performance of the portfolio to which the insurer's premiums are invested. That means that you or the policy owner takes the full risk for the investment returns, and the returns are not guaranteed because what you're investing in is not guaranteed, like the stock markets, for example. So in short, with whole life, you get a guaranteed interest rate and it's in a general account which is managed for you. That is for older people who can't take a lot of risk. For variable life, it is in a separate account. Your returns and interest rates are not guaranteed, and it is much more for younger people who can take a lot of risk. Alright, now I'm going to give a full permanent life insurance rundown. Whole life policies give interest on cash value based on a set interest rate. For example, 3 to 4% for old people. Make sure you get a guaranteed 3% interest on cash value because you need to beat inflation. And inflation is somewhere around, I believe, 2%. So whole life policies are much more for seniors. Now, variable universal life VUL cash value is based on the stock market. It's fit for young people. Your returns are obviously not guaranteed because you're invested in the stock market. But for the performance of the stock market, you can actually make a lot of gains. Now, for all of these permanent life insurance policies, you don't have to pay tax. And this is where the tax-free comes in. Because you'll take the money out as a loan, a 0% loan. You don't pay taxes on loan. You only pay taxes on income. Alright, now let's talk about the long-awaited index universal life. We did not cover this in this series, so we're going to cover it now. So pay attention. The target for IULs are for baby boomers, and it is invested in the stock markets. For example, think index funds. But the difference between this and VULs is that you do not carry the risk of losing money. You only capture the gains. When it goes up, that is only then where you capture the gains. If it goes down, it only goes down to a certain point and you don't actually lose any money. Now, how do they do this? How is it possible? Good question. So IULs uses the same sort of account as whole life in that they use a cash value account that is a general account. So it is managed by the insurance company, but they link your interest rate to the market's performance. For example, the market being something like the S&P 500, the Dow, NASDAQ, something like that. IULs are hedged with a floor and a cap. Okay, what does a hedge mean? What does a cap and a floor mean? A floor means downside protection. It basically means that the insurance company has got your back. If the market goes down below 0%, like say -5, then you get 0% return for that year or that time span. You neither make nor lose money. If it goes above the cap, then you get the cap. Say that the market makes something like 12% and your cap is 8%. Well, the most you can make is 8% despite the market making 12%. Now that floor and the cap is what forms what we call the hedge. Money is not invested in the market like a VUL. It is with the insurance company. In this way, you get downside protection and upside potential. With VULs, you need to manage it because it's in a separate account. Just the difference is that if the market gets 12%, they don't have a cap. On a VUL, you get that 12%. But if the market falls below 0 and goes to -5, you get -5. It's just know that with an IUL, you don't need to change strategies because it is a conservative strategy. So you don't need to manage or change strategies. With 401ks, you have to manage that strategy as you age because it should be more aggressive when you are younger and can take risks. But when you're older, you should change that to something more conservative because now that you're older, you can't take as much risk as you did when you were younger. Change of strategy is really unnecessary for IULs, and the typical performance or the average over your typical investment horizon is 6%. Alright, now some final notes. With permanent life insurance, here's what you get. You get a death benefit if you die early. You also get long-term care if that is needed, which in most cases you'll likely need. And we'll discuss that in a later video because a lot of people think that the government will take take care of that, but they won't. If you are healthy, then you get the cash value that was invested for you, that grew over the years to an amount that is unimaginable. Lastly, you get to avoid taxes by taking a loan with that cash value. Guys, it's really a no-brainer if you're concerned about financial security in your later years and your family. And with many things like this, it's best to start early. But sadly, people don't consider these things until really it's too late. So if you have any more questions about insurances or life insurances, health insurances, then let me know in the comments below, or you can actually email me by going to my channel and finding my email there, or joining our Discord server where we're sharing more information, cryptos, passive income, and insurances, and stuff like that. Other than that, I hope you got some value out of this video, and if you don't mind, please smash the like button and smash the subscribe button so we can get this video pushed out to more viewers who need it. Alright guys, I'll see you guys next time. Peace.